Hello students, we are going to practice how to capitalize the interest cost during a long-term construction. As we discussed in the class, all the acquisition cost to capitalize the long-term asset, we include all expenditures related directly to their acquisition or construction. Invoice prices, freight costs, installation charges, or sales of federal taxes, or possible addition, even the interest during the construction period, because that is the part of the construction in progress, the CIP we practiced in inventory. So let's go to the practice. You should remember we have this 3 steps to get the capitalized interest cost at the end of the day. So first, calculating the weighted average expenditures. All the expenditures are not occurring at January 1st, for example. It's unrealistic. So some expenditures occurs in a different time frame. Then avoidable interest cost, if we not constructed, what amount would be the avoidable interest cost, so that we will compare actual interest cost, actual interest expense, and avoidable interest cost on the step 3, and to choose the lower one that can be the represented to the capitalized interest cost. Okay, question. ABC company is constructing a new building for its own use. The company paid the following amounts for the construction during the year. February 1st, $30,000, July 1st, $40,000, and October 1st, $20,000. Also, the company incurred the following debt during the entire year. The loan specifically related to the building construction, $25,000. That amount is only for use to construct the building. And other borrowing of $50,000, 15%. And what are the interest costs to capitalize? Calculating the weighted average expenditures. As I mentioned earlier, this $30,000, $40,000, $20,000, the expenditures, the company paid in a different time out of this throughout the year. So $30,000 times, it has been used for 11 months, right? Because that expenditures incurred February 1st. In the same way, the July 1st, $40,000 times how long month? Right, 6 months divided by 12 months. This $40,000 has been used half of the year during the year. We just want to calculate the interest cost to be capitalized exactly along with the expenditures for the time used. Okay, and then $20,000 for the last from the October, 3 months. So we got the weighted average expenditure 52,500. Now let's calculate avoidable the interest cost to compare the actual interest cost to get the lower of actual interest cost or the avoidable interest cost to be capitalized. First, the weighted average we calculate already, and then the less specific borrowing for the construction. Less specific borrowing. How much is the specific borrowing? In the question, $25,000 is the amount for the specific borrowing to construct the building. So we put $25,000. Then, what is the remaining amount for the construction from other borrowing? Because we assume that $25,000 used up for this 52,500, and then the rest of this amount should be right 52,500 minus 25,000. So 27,500 out of this other borrowing, $50,000 is used to construct the building. Okay, then we can calculate avoidable interest cost for specific borrowing if not constructed. So 25,000 times, how much is that? Right, 10%. We have to put the 10% interest the rate. That is avoidable cost from the specific borrowing if not constructed. In the same way, 27,500 times 15% from other borrowing interest. If we didn't construct this building, that is the avoidable interest cost, 4,125. So total avoidable interest cost for this construction is 6,625. Now, let's calculate the actual interest cost to compare total avoidable interest cost to determine which one is lower to capitalize. Here, now, 25,000 was a specific borrowing total amount. Anyway, the company should pay this $25,000 from the specific borrowing with 10% plus, right, auto borrowing $50,000 times 15%. So this $10,000 is actual interest cost of the company should pay for the entire year, because the company incurred the following debt during the entire year. So this amount with this, the interest rate should be applied annually. And total avoidable interest cost we already calculated here, 6,625. Which one is lower? Yes. So we choose the total avoidable interest cost, 6,625. That is the capitalized cost. So what account do we need? Yes, we put the construction in progress, which is CIP. That is CIP account. So I put the 6,625. And then here, cash out for the interest expense here, 10,000, and then we put interest expense. How much actual interest expense the company should recognize? Because the company recognized the capitalized this 6,625 out of total 10,000. So the difference between two is interest expense the company should recognize. Okay, then let's put that information into the balance sheet, cash out, and then CIP increase to capitalized on the asset account, and then interest expense here, negative 3,375. Then we should be related to, because we don't have any other information, so we matched out. It's very simple, the exercise. See you in the next video clip. Bye bye.